Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, August 26, 2015. All right, now we're in business. We've got something to work with. Okay, we have a low in place, at least for the short term. And there was two scenarios last night, if you remember. One was we can come back and retest this low and maybe pierce through it, make another little low, not far behind or not far below, and then rally up for a few days into the Labor Day holiday weekend, and then roll over again. Option number two was we continue higher up through the holiday weekend, or at least into some point next week, and then roll over anyway. So end result is the same. It was just a matter of whether we were going to make a new low or not, and I said to you, we'll know it when we see it, and I'll try and update you in the middle of the day if I can. You know, if I see something that's relevant. So I did that today. I sent out an email to the members. Hopefully you got it. It was in the middle of the afternoon. And basically it was the beginning. I saw the beginning coming of a short squeeze. And that's really what happened today. So if you look here, let's go to the intraday chart. All right, here's a 10-minute chart. And, you know, we opened up the day here. Okay. And once we traded and closed above this level here, which was at a high of 192.49. Okay, so once we closed above that level here, all right, we tested it first over here, then we closed above it on this candle, and then I knew the short squeeze was going to come in for the rest of the day, but it's not only for the rest of the day. I think that's the beginning, right? And, you know, there's no guarantees in this business. We all know that, but here's my roadmap, all right? I think the next order of business, and it may not all happen in 1 or 2 days, right? We could have a pause day tomorrow. Maybe the market's flat. Maybe it's down slightly. Maybe we go up into Friday. You know, it remains to be seen. But what I think is going to happen before this move is over is I think we're going to fill the gap that was made on the daily chart right here, okay? This gap, okay, I think will get filled. And that gap gives us a number of the actual low is 197.52, but the actual gap is 197.63. Okay, so 197.63 would be sufficient to fill this gap. All right, so that's another 3 points higher than we are now in the spider. All right, so figure that's about 30 S&P handles, and that's not the maximum move, but that's what I believe is going to be the minimum move. Okay. Don't forget, once we get going here, and we got going today, and they have this short squeeze, all right, they've got to, in order for the market to go back down after the fact, is they've got to suck everybody in and get everybody buying the market at the highs on good news, and you know, we made the lows, and you'll hear all the analysts come out and march them on TV saying, yep, we had the correction we were looking for. We haven't had a correction like that in 6 years or 5 years. It's here, it's done, it's over. Now we go straight to the moon. All that stuff is going to happen. And then once that happens and they suck all the retail investor back into the market, right at the top is at the point in which will roll over again. So what I did was I put 3 other areas of resistance on the chart. 198.07 is number 1, and it's really just higher than the gap fill here, which is whatever that number was I just told you, 197.63. Okay, so you have 197.63, then you have 198.07. So figure 198's a fair number, give or take 25 to 50 cents, all right? And then you have the even number of 200, and then you have another number of 201.63. Now, these are calculations that I came up with, and it's interesting because it depends on where you draw the calculation from. So the reason I have 3 lines on here is because I mixed and matched just in case, because it's an art form, right? Do you take the pivot high to pivot low from the July pivot, which was really the cycle top? Or do you take it from the last pivot, which was the beginning of the decline right here on August, what was it, 20th or 18th, right? So, you know, I did them both, and I did the calculations from high to low and came out, and I gave you 3 numbers, really 4 possibilities, gap fill, and then these 3 numbers here. The point is this is what we're going to do, and I want to talk a little bit about a trade we put on today, and I've already gotten a couple of questions, and rightfully so, and the question is, why would I hold SPXU, which is short the market, and buy SSO at the same time? Let me explain. And those are good questions. They're very valid questions, and I don't blame you. So I should have explained it in the email, but I wanted to get the trade out quick enough. But it's good to ask, and let me give you the answer, okay? So SPXU is going to be held, at least in my portfolio, for another, I would say, at least 6 weeks, maybe 8 weeks, okay? That's at the point in which I think will make a meaningful low towards the latter part of October, and it may even be a little longer. Well, I don't know it yet, but I'll know it when we get there. But that's kind of my roadmap, what I'm looking for. And I think that the market's going to be a lot lower than we were at Monday right here, okay? So I'm comfortable holding that. I don't want to get whipsawed in and out of these things. So let's say, for example, I sold SPXU today, and I bought SSO. And let's say the market went down, let's say the S&P was down 30, 40 handles tomorrow. Okay, then I feel like a fool. I'm feeling bad because I'm losing money, and I could have been making money, or I could have at least neutralized it, right? And same thing goes for anybody that followed me into the trade. But here's the way it's going to work. I'm only planning on holding SSO for potentially 2 days, 3 days, maybe 4. I don't even think much longer than that. So what I'm going to do is I'm going to trade around that SPXU position probably 2 or 3 times in between now and the end of October, okay? So if it all goes to plan, right, if the roadmap plays out, all right, and we go up in this zone, all right, let's say we go up into this zone here, somewhere in this neighborhood, maybe here, maybe higher, maybe up here, all right? I'm going to take SSO off, and I'm going to take 3, 4, 5, 6%, whatever it becomes, maybe it's 7% off the table in a couple of days, all right, if the roadmap plays out, 2, 3, 4 days tops, all right, and then I expect, and maybe not before, but certainly after Labor Day, I expect the market to roll over again, all right, and in that time frame, I'm still going to have SPXU, and by the way, believe me when I tell you, by the middle of September, we're going to be back down here again, or worse, and SPXU is going to be right back where it was yesterday, okay, or the day before. So I'm not worried about it. I'm looking at SPXU as a little bit longer term, and long term to me is certainly long term is 2 months. That to me, that's long term. But I'm trading around it a little bit, pocketing some profits in SSO along the way, and that's the philosophy. I know it's a little unconventional. I know it may not make sense to some folks right out of the chute, but hopefully that explanation makes some sense. And by the way, you don't have to. Obviously don't have to do anything I do. I'm just telling you what I'm doing, and you handle it any way you like. I just didn't want to get whipsawed and run the risk of selling one, buying another, and having the market reverse, which could happen. Let's say the market reversed tomorrow. I don't feel so bad because nothing really happened, right? I'm not going to be gaining or losing much, if anything, maybe a little bit here, a little bit there. But and then I'll kind of reevaluate the situation and decide which one I want to hold if that happened tomorrow. And maybe we have a little tiny pullback tomorrow and then go up Friday. We'll see. But that's my philosophy on the trade and the reason I did it. So hopefully that clears up the confusion there. And I understand it was confusing a little bit. So all right, let's wrap up the market and then we'll move on. So we're in the middle of a short squeeze. We're in the middle of sucking the little guy into the market. We should have more upside. Today was the day where I noticed a characteristic change in the market. I tried to let you know as soon as I noticed it, as early as possible. I know some folks hopped on, and that's good. Whether you play the E-mini contract, whether you play SSO, SPY, whether you bought some stocks on your own, it doesn't matter. Everything's going to get a facelift. Everything's going to get inflated over the next couple of days if I'm right and we get up into this zone here. Could we even go higher than this? Sure we could. It's possible. I don't expect it, but it's possible. Remember this here. Hold on. Let me just get my pen out. Remember this here, okay? Don't forget about this trend line that we had in here for a while, right? A couple of months. We could, it's conceivable, it's not probable, in fact it's improbable that we get up to retest the underside of that line, but it's possible. It's not probable. It's possible. Anything's possible. Okay, so that's my story and where I think the market's going from here. But remember, okay, regardless of what happens between now and Labor Day, okay, I think the market, in fact, I'm pretty sure that we're going to pull one of these jobs, no matter from what number. It's time. Time is more important than price at this point, okay? Price is not important. I don't care how high we go up or how high we don't go up. It's time. After Labor Day, I'm going to start looking, or maybe before Labor Day, I'm going to start looking for more short positions in the market for the next rollover. Here's the rub, and you all got that email from last night, a sad story. It was a terrible situation for the individual. I get it. We've all been there about, kind of getting his account wiped out. But, and some of you emailed me saying, no, I was listening. I got it. I got the point. You were clear, crystal clear what was going to happen. I want to be crystal clear again. Unless I change something, unless I tell you differently, okay, the market's going to have similar or same or even more volatility going into September and through into probably October than it did just this week, okay, and last week. So while the VIX may not get up that high, we may not get the intraday swings that we got over the last 2 days, okay, this one here and this one here, okay, but expect these swings, okay, down, up, down, up. I mean, there's no doubt in my mind that we're going to have increased volatility, big intraday swings, gap higher, rumors, news items, market rallies and sell-offs out of nowhere, just like we've been having. I told you to get the life vest out, keep it out. You're going to need it through September and into October, and maybe even beyond, but we'll know more when we get there. It's a little early to tell how long it's going to last right now. Okay, so let's just take our trip around some of the other indexes and see what we've got here. The IWM had a nice day today. It was up 2.5%. However, it was the laggard, right? The IWM was still lagging the S&P. The Spider was up 4%, $7.50. The IWM was up 2.5%, $2.73 on 112. Okay, that's not the same. Okay, so understand that this is still the lagging index. Okay, it's probably going to stall out, my guess is, at this trend line. And for the new folks, and I know there's some new folks in here, we always get new folks when the market goes down. I don't blame you. You're looking for some answers. You're welcome here. We've got some folks on a trial, and we've got some new folks as members. Welcome to the party. This trend line comes from the weekly chart, okay? And unless we can close above this on a weekly basis, I don't think that we get above this trend line other than maybe to peak above it for a day or so. But unless we can close above this by Friday, for example, no dice. Okay, this is probably going to be your resistance point. That's the way I see the IWM right now. If this resistance point, if this trend line is going to come in at about 116, 116 and a quarter, and we're 112 now, and this was a 2.5% up day, I don't see it. I just don't see us getting up to over 116 over the next week or so in the IWM. We'll see how it plays out. I could be wrong, but I just don't see it as things stand right now. And again, for the new folks, why do we look at the IWM? The IWM is more representative than any other index as small business across America. This is you and me. This is mom and pop across America, small and medium businesses. Okay, these are entrepreneurs. These are not the big conglomerate public companies. This is representative of America. It's 2,000 companies in the IWM or the Russell 2000 index, okay? And this is more representative of what America really looks like at Main Street level, okay? And at Main Street level, this is telling you that it's lagging the bigger indexes with the bigger companies, okay? This is where your risk assets go, and your NASDAQ is where your risk assets go, okay? There's no dividends in here, or very few, and therefore, your risky assets head to the IWM and the NASDAQ, and guess what? When the waters get rough, that's where they come out of first, and that's what's been happening. So you can see this index has been lagging, so it's basically been leading the market lower the whole way down, okay? So this is our tell. We look at this, if not every day, we look at it at least a few. I look at it every day, all day, but I generally bring it up in the videos at least 2-3 times a week. It's very, very important. Okay, let's look at the transports. Transports came right back to test the underside of our support and resistance line at 7,700. Okay, so if we're If we're going to continue up over the next couple of days, we're going to come through that support at 7,700, which is now resistance, right? Prior support becomes resistance. And we're probably going to get up into this zone here, which will coincide with the level in the spider, okay? So we probably have another 150 points in the transports if we're going to do the upside that we discussed earlier in the video, okay? Now, let's go over to the gold market, all right? So I put out a trade alert today for a purchase in gold. Now, remember when I had been telling you that we're still inside of, in the bigger picture here, we're still inside of a bullish pattern in gold. Okay, there's nothing wrong with a pullback pattern, okay? This is a pullback pattern right into support. We came almost into the 20-period moving average, comfortably below $1,112. Now, I will tell you that if we close below $1,112, I'm going to have to reevaluate that trade, okay, on a daily chart closing basis or daily closing basis, all right? I don't expect that, but it's certainly possible. Anything's possible in these markets. But the fact that we had 3 solid down days, okay, off of the pivot top that we had from the other day, okay, we kind of went through my resistance point at 1157. That's okay. The momentum was strong to the upside, but this is fine. This is a normal retracement. Okay, if I show you, and I haven't even done this, but let me show you the retracement from our low to high point, okay? I can eyeball it, and I tell you, yeah, I knew we were close. Okay, we're getting close to the 618. The 618 is at 1110. I wouldn't be surprised to come down and test 1110, but I don't want to close below 1112, okay? So that's just my thought process. Why did I get in before we tested 1110? Because I don't know that we will. We came into the 50% retracement, which is good enough for me based on some other factors I'm looking at. Okay, this is a lot of support over here. So let me do that also with you. Whoops. Let me just get rid of these fib lines. Bear with me. Okay. So this is a breakout point. Okay. We came back down to test the breakout point. Okay, so we basically tested almost the low of this candle here, which was the breakout candle for the up move. Okay, we had 2 up moves. One off of here, okay, so the first up move does this. And this is, I'm mainly doing this for the new folks, right? Because you've seen me do this dozens and dozens and dozens of times, but I want to do it for the new folks too. Here's an up move, sideways consolidation, another up move, okay? And markets have a tendency to come back and retest prior breakout points, okay, and they'll find support through prior chart congestion, which is right here, okay? So just like we found resistance, okay, up here, why? It was over here, the prior breakdown level, okay? This is the same thing if you just flip around the chart. It's the same identical thing. I told you one of the reasons, not the only reason, but one of the reasons why I like the 1157, and I told you there's a few dollars worth of leeway in there, was because of this breakdown point. There was chart congestion here, okay? This was telling you the bulls are fighting the bears. It's called vibration, and this was the breakdown point, okay? So the market fought over here. We made bearish consolidation, okay, and then broke down. Okay, if you think about that, what I just told you, okay, this is the same thing. We had a bullish pattern, consolidation, and up move. Okay, so here we came back to test the prior breakdown point, and here we just came back to test the prior breakout point. Okay, it's just the 180-degree opposite scenario. When I showed you this for, a week or so ago already, okay, this is the same thing on the other side. That's one of the factors I used, along with some other calculations, to say I'm comfortable in this zone as long as we stay above $1,112 for the bullish pattern to continue to play out. So I'm expecting higher prices in the gold market from this point forward. And if we get a close below $1,112 on a daily closing basis, I'll have to reevaluate. That's where we stand. Okay. Let's talk about GDX for a second, because GDX got hammered. Okay, it's gotten hammered for 4 days in a row, and gold was down, obviously, 3 days in a row. But here's the scenario. This is going, gold, GDX is made up of gold miners. And the reason I'm talking about it is because I know a lot of folks like the GDX, they like the miners. And so once in a while I like to talk about it because I get some questions on it. I have no problem with it. But here's what you need to know. If you're interested in gold, I would rather see you play the pure metal, okay, in some way. It doesn't have to be GLD or DGP. It could be any of the vehicles that plays the pure metal, okay, as opposed to GDX, because if the market comes down, the stock market comes down and gold goes up, which we saw over the last couple of weeks, okay, if that happens, then there's no guarantee. In fact, it's more likely that GDX comes down, gets sucked down with the market because it's made up of stocks, and it doesn't go up with gold. So I would rather see you play the pure metal gold. I'm not comfortable with GDX down here. I thought we had a chance at 17 and a quarter, had this line in here from before. And you know what? We got to 16 and a quarter, or roughly there, 16.39. And then it failed. Now we're down here at double bottom. It's probably worth a try down here at double bottom, as long as I think the market should hold up, the stock market, and if gold starts to rally, you should get a bounce here off double bottom, and your stop out is basically today's low. So today's low is 12.96. You can use that to trade against. It's at 13.04. Wherever we open up tomorrow, your stop out is a daily close below 12.96, and you can trade against that. Other than that, you got to be careful with GDX. All right, let's move on. Let's go to crude oil, not September. Let me, just bear with me. I got to get rid of the September contract. I keep bringing it up by accident. Okay, October. All right, so in the October contract, okay, I told you we were trying to put in some kind of a bottom, possibly at $38. Okay, we tried to rally yesterday, failed today. You know, there's just nothing to see here. That's my take in the price of crude oil. Okay, so we're basically now, you know, I don't know for sure because we need this to play out for another few days. But you know, what if we're putting in another bout of sideways consolidation here for another move lower? Okay, I don't see how oil, when and if the market goes down in September and October, I don't see how the price of crude oil rallies. Under what conditions would that happen? I can't come up with the answer. And until I see a bona fide reversal and follow through, and right now the only thing we're looking for, and I think I told you this last night or maybe the night before, is a close above 40.47 in October crude. Until we see a daily close above 40.47, this doesn't interest me in the least bit, right? And even if we did, we would have to see some other reason, like a pattern develop or follow through to the upside. And then most likely we would end up stalling out at the next resistance point, which would be right up here, coinciding with the 20-period moving average and this high here at $42.5 to $43. Okay, so I just don't see the rationale or anything I can come up with from a technical perspective and for a reason to buy crude oil, be long crude oil. Sure, if it rallies $3 or $4 from here, you could have said, well, I could have bought it at 39. Well, yeah, sure, you could have bought it at 39, but I don't have an advantage. I don't have the odds in my favor. I don't have the probabilities in my favor with anything I can see, technically speaking, on the charts to buy crude oil. So my advice is leave it alone. Let's go to the bond market. We had a bond market got whacked today pretty good. And if you remember the last last couple of days, I was telling you that this level would be the first line of defense that we would see in the bond market. This is the 30-year Treasury bond, not the yield, but the price of the 30-year Treasury bond. Okay, so that didn't hold, but this level so far is holding okay. Sorry about the squiggly line. So, you know, I have to believe that this level will hold, and let me explain one of the reasons why. It goes to something I just told you with the chart of gold, okay? Now, if you look here, okay, in the bigger picture, okay, just pull back the curtain a little bit and step backwards. We're in a bullish pattern, okay? Up move, sideways, okay, potentially another up move. But the fact that we went down like this today puts that in jeopardy, okay? And I said I would start getting concerned if we closed below this level here. Whoops. If we closed below this level here, all right? Right? So we closed below that level, all right? Then I said the next line of defense is here, okay? But here we're into that prior breakout point, all right? The market went up, consolidated, all right? And then it went up again. And what did we do here? we just went back to retest the prior breakout point and consolidation point right here today. Well, I didn't mean to do that. I draw the line with the mouse, so you have to forgive me. It just slides across the table and sometimes does that. So right here, we're basically into that prior breakout point. So I have to believe that if we can hold up tomorrow, then we're probably going to see slightly higher prices over the next couple of days in the bond market, not the yields, but the price of the Treasury bonds. If we break down below this area, all bets are off, and then I'll have to reevaluate. So let's just flip over to the TLT and see what we've got. You know, it's the same routine. We found support at this prior breakout point, all right, but we have the 20, this is the 50. The blue line is the 50-period moving average upsloping. But this was a pretty good sell-off. So it may be that the market is signaling us that something else is developing in the bond market, and maybe we're not going to see new highs again. And remember last night I told you, and for the new members that came around today, last night I was explaining how, let me go back to the, I can use the TLT. Let me go to a longer-term chart and show you that, you know, we could potentially be seeing on a weekly basis a set of lower highs. And a set of lower highs is a very bearish chart pattern setup. So if you look here, we have highs, okay, from early in 2015, a lower high, April-May time frame, and if we make another lower high here and don't recover, okay, we're going to see significantly lower prices in the price of Treasury bonds and higher prices in the price of bond yields, which would be very, very bad for the economy because the cost of borrowing money goes higher. Bad for corporations, bad for you and I, bad for mortgages, bad all around the block. Okay, and this isn't something the Fed can necessarily control. The free market trades Treasury bonds unless the Fed is in there with a liquidity program, QE 1, 2, 3, 4, 5, 6, okay? But right now they're not in there with a QE program, quantitative easing program. So therefore, if liquidity has dried up and there's nobody to purchase bonds and nobody wants them, and some of the other entities like foreign governments decide to start dumping bonds into our market, back into the market, okay, or anybody, banks that are holding Treasury bonds, if anybody starts dumping bonds into the market, it's going to drive prices lower. Okay, so what I'm telling you is that it's going to be very interesting to see where this week closes, because this is a weekly chart and this is a pretty healthy reversal candle. Okay, so if for example we were to close this week right here, okay, this would be a reversal candle, and we're going to be looking for lower prices in the price of Treasury bonds, higher prices in the yield. Okay, so this week is very important as it stands right now, because this is putting in a reversal candle as we speak. And how do I know that? Well, look at this one. Reversal candle. Reversal candle. Okay, this was a bullish pattern, okay, over here. Up move, sideways, and instead of another up move, it was a failure with a reversal candle. That's very bearish. We went down, okay, we found support down here. This line's been in there for months. We actually bought this for the new members at 115.43. We bought this level, not 3 times, 1, 2, 3, but twice. You remember I chickened out once. For those of you that have been around, I chickened out here. But nevertheless, you know, this is a reversal candle, so it's something we have to pay attention to. All right, let's move on. The dollar. Up move in the dollar today. We'll have to see how this one plays out too. We had a pretty good up move this week in the dollar off those lows, and I would have felt really, really comfortable had this market gone down and tested 92. But that didn't happen, and I'm pretty sure we're going to see higher prices in the dollar. In fact, I did a calculation here. Let me just get my notes out. 95. Give me, here, let me draw it in for you. 95.20 is the number. Okay, 95.20 is the number. And I think, oh, we hit it today. I didn't even realize it. My fault. Okay, so that completes that one. Then the next, well, if we close above 95.20, then the next area of resistance would be 96.15, which was our prior area of support from here. Okay, this line's been in there a long time for those new members who are here also. Okay, so I think there's still higher prices coming in the price of the dollar. and significantly longer term higher prices coming. But even for the shorter term, if we close above this line, and we got rejected today or found resistance at this line, even though it wasn't in there at the number, and then at the 200 period moving average. But if we close above this line tomorrow, then we're going to head for the 96.15. Okay. Let's go and wrap it with natural gas. Natural gas had an update today, and we're trying to creep into the channel here. We did it. Let me go over to the 60-minute chart and show you how whippy this market is. Look where we go. Up, down, but you can see the patterns playing out. You know, I like to talk about the patterns. You see the up move, we consolidate, okay, and then another up move, and then we fail, and then we have an up move, consolidate for a while, move higher, and now we're coming back down. Are we consolidating or failing? As long as we stay inside of this area here, okay, inside this big red candle here, let me redo that, okay, as long as we stay above this area, then we could still see higher prices, but I find it hard to believe we would see significantly higher prices in natural gas if we're going to see higher prices in the dollar right away. And if for the newer folks, let me show you something else. And the reason I keep saying that is because there's several folks came on board this week. I know they're looking for information. I don't blame you for stopping by to check it out. You know, with the markets as volatile as they are, I know a lot of folks get this stuff wrong. Most people are wrong most of the time. My existing members know I've said that many times. So you're welcome here. Hopefully this stuff is helpful, and we appreciate you trying us out. Okay, so longer term basis in natural gas, there's nothing to see here. So on a daily basis, intraday, you know, we have these decent swings that you can trade if you're a natural gas trader. But here, down move, sideways consolidation, I have to believe this is just going lower. I mean, this has been consolidating for months, 8 months, 9 months. I mean, this is going lower, and it's just a matter of time before we break away from the bottom trend channel, the bottom of the trend channel that we have in here. So, you know, maybe this holds, maybe it fails. We have to see. If we close and confirm inside this channel, then we're going to challenge this red bar high here and the 20-period moving average. But other than that, I don't see any real material reason to be a long holder of natural gas. And you folks know I don't like to trade natural gas myself, but I'm happy to go over it for folks that do. It's the widow maker, and I'm not interested in making a widow out of my wife. So with that, I'm going to leave it there tonight. If you have any questions, shoot me an email. I'm happy to answer them. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.